3 years ago, in December 2012, UBP's European equity team decided to launch the Euro Equity Income Strategy. The objective of the strategy is to invest in companies based in the Eurozone that have the ability to generate a stable and/or growing dividend, with the final objective being to try to beat the yield of the Eurozone index, the MSCI EMU. Now, the background behind this launch was the fact that the team had very good and strong experience in investing in European income stocks. And testimony to this good stock picking was that the strategy was initially seeded by an institutional French investor. The co-managers, Scott Meech and Victoria Leggett, joined UBP in 2010 with the rest of the European equity team. What's remarkable about this team is their experience in investing in European equities, their collegial approach, and their strong and very stable track record. The results after 3 years of running this strategy are very, very encouraging. We have managed to beat both the yield target and the total return of the MSCI EMU. We remain very optimistic as in Europe, corporates have a culture geared towards dividends.
Looking back at the end of 2012, the opportunity to create an equity income strategy was clear. Corporate bonds had very low yields, and equities, even strong, quality, highly defensive, cash-generative businesses, were yielding in some cases over 5%. A lot has happened in the last 3 years. The market performance has been very strong, particularly in European equities. The type of stock which may originally have been in this fund, in some cases, the performance has been so strong that despite some dividend growth, the yield is now much lower.
Not only have dividends grown over this 3-year period, but many companies that weren't paying dividends at all have begun to pay dividends and returns to shareholders again as they've restructured and recovered, and particularly within the financials sector of the market, that's been very clear. There are many more banks now paying cash dividends today than there were 3 years ago. Telecom sector, where 3 years ago most companies in the sector were still over distributing, still had too much debt, and returns were still falling.
Now the landscape is changing, and particularly for financials in the southern European countries who have undergone a huge amount of restructuring. Their dividend yield may be low, but the growth is high, and as part of a portfolio, we think they're a compelling idea.
So to summarise, we can still see a very big gap between the income opportunity available to us from European equities in dividend yields and what's available in corporate bonds and government bonds. That spread is still as big as it's been. So we can construct this nice portfolio of good quality companies that also offers dividend growth. And returns in Europe for companies are still recovering, so we still see some good years ahead for this strategy.
So as we look forward into 2016, it's actually just as easy to be as excited about an income opportunity as it was in 2013. The stocks may be different, but the opportunity is just as big.